Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome back to our weekly podcast Through the Noise. My name is Hannah, Portfolio Strategist with the Standard Chartered CIO office, and I will be your host for today. Joining me today is Rajat, our Senior Investment Strategist, to help unpack market events and talk about positioning and where the opportunities might lie next. So hi Rajat, thank you for joining us today. We're going to jump straight into it, and first up we'll touch on oil. So we've seen oil prices, they've dropped quite sharply from April's peaks as shipping through the Hormuz Strait has normalized quite gradually. What are some of the implications for investors?
Hi, Hannah. Great to be here. You're right. The Strait of Hormuz reopening actually could mark the turning point for the global monetary policy cycle, I would say. With the US crude oil back below $70 per barrel, the energy inflation threat has likely faded, allowing central banks to stay patient. Lower oil prices have dragged inflation expectations and long term bond yields lower in the US and Europe since the peak in May, unwinding much of the hawkish repricing we had seen earlier. Now, softer US payrolls data for June earlier this week has pushed back all expectations of Fed rate hikes. The relief is visible across major central banks, except for Japan, I must add. Most are now set to stay on hold or creating a lower rate volatility environment. The Reserve Bank of Australia has turned neutral after three rate hikes this year, while weak Swiss growth and subdued inflation argue against further tightening in Switzerland. Now, even the Bank of England Governor Andrew Bailey, while not ruling out a hike against energy price risk this week, left open the door to return to easing. Now, what we have is the BOJ, the Bank of Japan, which is mainly where inflation is mainly driven by wage growth. That remains a clear outlier in this scenario. Now, this overall backdrop should lead to consolidation in the US dollar and support global equities, particularly the rate sensitive tech sector. Equities in Asia, Japan, which is especially where oil importers such as China and India are the big players, should benefit also from this pullback in oil prices.
You mentioned the softer US job report that we saw in June, and it sort of pushed back some expectations for the Fed rate hikes. Perhaps you could unpack the thinking behind this and what this means in terms of the policy outlook.
Sure, let me do that. So the June US non-farm payrolls missed the consensus expectations big time. In fact, it missed by half what the consensus was expecting. And most of the job gains were concentrated in the education and health services sector, which has been a structural theme for a long time. And this is what that means is it's reversed a broadening trend in the job market in the prior months. Meanwhile, wage growth held steady at 0.3% month on month or 3.5% year on year, keeping inflation pressures contained. Now, the report challenges the market's narrative of an imminent Fed rate hike, pushing back market expectations back all the way to December. Now, we remain skeptical the Fed will hike at all this year as inflation pressures ease with the recent drop in oil prices. At this week's ECB forum, in fact, Fed Chair Walsh pointed to lower bond yields as evidence that markets are pricing lower inflation as oil prices fall. Now, ECB President Lagarde also said inflation and growth risks were more balanced after last month's hike. The message is clear. Lower oil is already changing the policy outlook. With Hormuz shipping traffic only a quarter of pre conflict levels, further normalization there should reinforce a more benign inflation backdrop going forward. Now, given this, we also expect the ECB to hold rates through the year end.
So given the scenario that you just painted, what does it mean for bond yields, maybe the dollar as well as global equities?
Yeah, this has huge implications, I must say. If central bank hawkishness has peaked, bond yields should further ease, we see value in the 3 to 5 year US bond yields segment in a stable Fed rate world, while stretched short investor positioning in the 10-year bonds points to easing back into the 4.25 to 4.5% yield corridor. Peak Fed hawkishness also implies dollar consolidation ahead after this recent rally that we've seen in the dollar in recent months, especially with investor positioning stretched. This is also supportive of gold, I must say. As global reflation broadens, volatile currencies such as the Australian dollar should benefit as the dollar peaks. This backdrop also supports global equities. Now, lower oil prices return purchasing power to consumers and supports the AI driven wealth effect for consumers. This favors Asia ex Japan equities, particularly held by expected double digit earnings growth, and as well as the rate sensitive technology sector, both in the US and Asia ex Japan.
Okay, maybe let's talk about some of the risk to this base scenario. So, what could possibly go wrong then?
Yeah, our core scenario depends on oil staying low and inflation cooling. If US inflation remains elevated on a stronger labor market, the Fed could be forced to tighten. AI could also prove inflationary rather than deflationary, at least in the near term, justifying higher rates. A hawkish wash U turn, echoing former Fed Chair Alan Greenspan in 2000, could challenge the AI led equity bull market. Finally, the fragile US Iran ceasefire could collapse after the US midterm elections in November, lifting oil prices sharply. We therefore need to stay well diversified and hedge geopolitical risk through gold and alternatives.
Okay, I do want to talk about one of the sectors which we saw that was quite impacted by the monetary policy hawkishness, the so-called Magnificent Seven or Mag Seven as we know it to be, which has underperformed in the first half of 2026. So would you say that now is a good time for investors to start adding exposure?
Yes, the Max 7 has indeed posted their first negative H1 performance since the AI boom began in November 2022. Now, the group returned minus 1.7% over the period, lagging the S&P 500, which actually jumped 10.2%, and the Nasdaq 100 was up almost 20%. Now, expectations of Fed rate hikes played some role in the underperformance. However, the market is now scrutinizing the relationship between investment and profitability far more closely. Guidance from the cohort's members to spend hundreds of billions of dollars on AI development has fueled capex fatigue, while equity offerings to fund the AI build out have added further pressure on individual names. Internal dispersion has also widened materially as investors increasingly differentiate between the perceived AI monetization leaders. Notably, leadership in the first half of 2026 rotated towards memory related names where tightening supply and AI driven demand supported stronger pricing power. That said, we believe recent concerns are overdone. Set against expectations of double digit earnings growth and meaningful monetization upside, the backdrop remains constructive. Valuations have grown more compelling, which offers an appealing entry point into some of the market's highest quality growth names.
Thanks, Rajat. So maybe let's turn to the FX markets. We see that the Japanese yen is now at a four-decade low against the dollar, despite the Fed hike. Despite the rate hikes that we've seen from the Bank of Japan. So should we see or anticipate, FX intervention anytime soon?
Yeah, the main thing there is the monetary policy drivers, which is driving this pair. The what is happening is the market is fully pricing in one Fed rate hike by year end, that and another hike in the first half of 2027. The repricing of rate expectations earlier had supported higher US government bond yields and wider US Japan rate differentials, overwhelming the impact of the Japan's intervention in late April. That intervention had briefly pushed dollar yen from around 160 to 156 before the pair resumed its climb to fresh highs above 162. In our view, Japanese policymakers are now likely to wait for a softer US inflation or labor market data that reduces Fed hike expectations before intervening again, as such a backdrop would increase the probability of a more durable intervention effect. Looking back at previous confirmed intervention periods, the risk of intervention is increasing now that the US labor data has softened and Fed rate hike expectations have been pushed back. Given that, with the spot close to 162, the Ministry of Finance in Japan may wait until probably 164 to 165 range before intervening.
Well, thanks, Rajat. I think there was quite a lot for us to think about, to digest. And yeah, so thank you so much for joining us here today. Maybe just as a final key takeaway for our listeners, we mentioned that the reopening of the Strait of Hormuz is a very critical turning point for markets, especially for, global monetary cycles. And as Rajat highlighted earlier, that lower oil prices could also pull down inflation expectations. What we could potentially see might be an unwinding of much of the recent hawkish repricing. But nevertheless, risk in the markets will always exist. So it is very paramount to stay diversified, as we have consistently advised our listeners, and to hedge your risk through assets like gold and alternatives. So that is all we have for today. Thank you, Raja, again. And thank you to all our listeners for joining us today on our Through the Noise podcast. And we do hope that you can join us again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.